Hi guys. Today we will analyze Ally Financial stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock is a bad performer in the overall market. The short-term trend is negative. The long-term trend is negative. There should be more interesting stocks out there. Support level is around $39. Strong support levels are around $33.50 and $30. Strong resistance level is around $45. Next strong resistance levels are around $48.50 and $55.20. In the last month the stock has been trading between $37 and $45 range. It is currently trading near the lows of this range. The stock has an average volume of 4.4 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a downward trend since October 2021. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Valuing financial institutions. Understanding why financial institutions are different from traditional real sector companies is key. Banks function differently than traditional cash flow-driven companies. Traditional companies create products to make money. The products of banks are money. Banks are highly levered and they do not reinvest debt in the business and instead use it to create more money. They make money via interest. So, they view debt and interest differently. That's why, our favorite discounted cash flow valuation method doesn't work for banks and insurance companies. Intrinsic values calculations. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. The excess return model. This approach is used for financial institutions where free cash flow is difficult to estimate. Then, we will use valuation based on earnings per share, EPS, 5-year average PE ratio and expected growth rate. First model. Excess return model valuation. This spreadsheet contains some financial data that we will use for the stock valuation. In this valuation I will use margin of safety. 30%. Once we actually figure out what we think this stock is worth, we are only going to buy the stock if it gets 30% of what we think it's worth. It gives us a big margin of safety if our predictions are wrong. In other words, when something is worth $1, I want to pay only 70 cents for it. I want to be conservative with financial institutions. So, my margin of safety is 30%. According to our formula, the fair value of the stock is $161.24. When we apply the margin of safety to that value, the fair value of the stock would be $112.87. That's the price that I may want to pay for this stock. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for Ally Financial is 8.2. Minimum rate of return. I will use 10%. Because when we invest in individual companies, we are looking for a higher return than the S&P 500. For Ally Financial, analysts forecast growth rate around 3% per year in next 5 years, and future PE around 5. I will use 3 different scenarios for Ally Financial Company: bad, average, and good. First scenario. Ally Financial will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 0%. Future PE would be low, 5. In this case, the fair value of the stock today would be $17. Second scenario. Ally Financial will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 1%. Future PE would be average, 7. In this case, the fair value of the stock today would be $27. Third scenario. Ally Financial will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 2%. Future PE would be high, 9. In this case, the fair value of the stock today would be $37. As you can see, today the stock is a bit overvalued, $39, even if we expect the company's high performance in future. The fundamentals are decent. And the stock looks fairly valued. However, the revenue will grow only by 0 to 2% on average per year in the next 5 years. Also, the stock has been in a downward trend since October 2021. It can go lower, before it recovers. The stock has been on my watch list for a while, and I like the stock at these levels. I may consider buying the stock when it shows signs of reversal. Company strengths. Ally Financial is a digital financial services company, provides various digital financial products and services to consumer, commercial, and corporate customers primarily in the U.S. and Canada. Ally is one of the largest car finance companies in the U.S., providing car financing and leasing for 4.5 million customers and originating 1.4 million car loans annually. It shows strong credit quality numbers, and a loan and lease loss allowance that appears more than adequately funded. The company has benefited from becoming a full-spectrum auto lender, and car sales volumes rapidly recovered from the COVID-19 plunge, when dealerships were temporarily shut down. Ally will maintain its dominant position as the largest auto prime lender. It's well positioned to offer new products through its growing all-digital bank. Ally also continues to expand into other financial services beyond auto, seeking to become a full-service financial corporation. Ally continues to aggressively return capital to shareholders through buybacks and dividends. The company announced a $2 billion share repurchase plan for 2022, which is about 12% of the company's current market cap. The company has a profit margin of 32%. This is amongst the best returns in the industry. Risks. The company's outsized exposure to the cyclical auto industry, particularly its leverage to the volume of new and used car sales, which plummeted due to COVID-19 auto dealership closures. Auto sales have rebounded, but are at risk of slowing. Ally is also exposed to used vehicle prices. Approximately 56% of average earning assets are leveraged to residual vehicle values. Used vehicle prices have risen, but there is risk of declines ahead, as COVID-induced supply chain bottlenecks normalize and recover. There are concerns that vehicle originations may begin to slow in 2022, as high inflation may stifle demand as consumers cut back on large-ticket items. Greater than forecasted deterioration in consumer credit metrics, which would lead to higher than forecasted delinquencies and charge-offs, a drop in auto sales, and weaker than expected employment trends. Ally has a return on assets of 1.6%. This is below the industry average of 2.8%. Ally has a return on equity of 21%. This is below the industry average of 22.3%. Based on estimates for the next 5 years, Ally will show a very small growth in revenue. The revenue will grow by 1 to 3% on average per year. Based on estimates for the next 5 years, Ally will show a very small growth in earnings per share. The EPS will grow by 0 to 2% on average per year. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.